Hello everybody, Andrew Barninger with Personal Wealth Advisory here, bringing you a relatively short video summarizing the One Big Beautiful Bill Act that was just signed into law a couple of weeks ago. It's a massive bill with a whole lot of stuff that doesn't apply to most of us, but there are a lot of really important things to know and understand. It's our job to pull those things out of a massive document and piece of legislation and boil them down to, hey, what do we really need to know from all of this so we can understand what planning opportunities we have and what's really going to impact us. So we're going to break this down into two videos. There's too many things to cram into one here. So this is just part one, focusing on the income tax changes that are important for most of our clients to know and understand. Again, there's a whole lot of things in this bill, from defense spending to Medicaid funding, all the way down to things that are going to impact your tax return this year, and that's what we're going to focus on. As always, when we're talking about taxes, please keep in mind that everything in this video is simply for educational purposes. It's not investment or tax advice, and we always encourage you to talk with us, talk with your other professionals before making any decisions. Just a couple high-level points before we dive into some of the important income tax changes. First and foremost, yes, the One Big Beautiful Bill Act is the actual name of this piece of legislation. I know a lot of folks thought there was a nickname that was given to this, but no, that is the actual legal name of this piece of legislation. It is almost 900 pages long, and that doesn't account for all of the references to pieces of tax code, which probably add thousands of additional pages as well. So, massive document covering a broad spectrum of topics, most of which don't impact your day-to-day life, but some of them do. Again, that's what we're going to focus on today, but huge piece of legislation. And some of the provisions that we're going to talk about are effective this year, even though we are over halfway through the year. Several of them are retroactive to the beginning of this year and will impact your tax return for 2025. So make sure we highlight those things. This is a big undertaking for the IRS. Not only do they have to digest the legislation, but they have to figure out how to enforce it. How are they going to require investment custodians to report things differently? What about W-2s from employers? They have a monumental task ahead of them to try to figure out how are they going to collect the information needed to enforce all of these new rules and requirements. Not only is the IRS down about 25% of their workforce, but they have to figure all this stuff out and try to figure a lot of it out for this tax year. Massive project for them, and there will likely be, as with any piece of legislation this big, things that are happening at the last minute. Certainly some changes from the law as we see it today. Still a lot to come on that front. And as I said a couple times, much of this bill doesn't impact your taxes, but that's really what we're just going to focus on today. Really the most broad and what are the main reasons for the tax part of this bill is it's an extension and a making permanent of the tax brackets that we have today, which started in 2018 during Trump's first presidency. He enacted the Tax Cuts and Jobs Act, which changed the tax brackets and extended them for 6 years until 2026. And unless those were made permanent, they would have reverted back to the pre-2018 tax brackets. So these current tax brackets that we have, which you see on the screen here, are made permanent. And we just line those up with the quote-unquote old tax brackets from 2017 and further back. So you'll see in general a lowering of the tax brackets, the board, and the dollar amounts that are captured in each tax bracket are also changed. I don't have those up there, but these new 2025 brackets, which are generally lower, are made permanent. That's one of the big parts of this tax side of this bill. Also made permanent is the standard deduction as it stands in today's tax code. You may remember, again, pre-Tax Cuts and Jobs Act, pre-2018, the standard deduction was much lower than it is today, and we also had personal exemptions. We had exemptions and deductions. The Tax Cuts and Jobs Act, for the most part, got rid of exemptions and increased the back. Single filers had around a $6,000 standard deduction, and married filing joint was double that at about $12,600. Today in 2025, and these are adjusted upwards. Not only were these made permanent, the higher deductions, but they were also adjusted upwards a little bit. You see your current standard deductions as they will hit your tax return this year. Single, married filing joint, much higher than pre-2018. And then those of you who are over age 65 get an additional amount of standard deductions. These are made incrementally higher for 2025 and made permanent. And again, this is something that's going to impact your tax return this year. This is a 2025 tax law change. I just mentioned personal exemptions going away under the Tax Cuts and Jobs Act, and it looks like we're bringing some of them back. And this may impact a lot of folks who are retired. This is a new personal exemption for folks over 65 years old. This is effective for 2025 through 2028. This is the first new provision that actually has a start date and an end date. Everything else we've talked about so far is permanent. This is through 2025 through 2028. $6,000 personal exemption per person over the age of 65. For a household of two who are filing jointly, you'll have $6,000 per person, or $12,000 on your tax return of personal exemption. And if you remember, personal exemptions are on top of your standard deduction or itemized deduction, whichever one you do. You'll have the exemption, either one person or two person, and then you'll have your standard or itemized deductions as well. So this is actually an additional exemption on your tax return. What's unique about this is there are income phase-outs. Income phase-outs meaning as you make more money over a certain threshold, that $6,000 will be reduced until it is gone completely at a certain amount of modified. So if your modified adjusted gross income is under $75,000, you'll get the full $6,000 exemption per person. Once you hit $150,000 of modified adjusted gross income, you won't be able to report any of that $6,000 exemption, and the same pattern applies to those married filing jointly. There's just a different phase-out range there. So again, a benefit offered to those who are below those thresholds. If you're in the midst of one of those, that bracket of adjusted gross income, you'll have an exemption, but it won't be $6,000. It'll be within that range of $6,000 to zero, somewhere in there. An important planning topic for those who are retired. What this means is, as we increase our modified adjusted gross income, we might lose some of our exemption. It's a cost of having more income. So we're thinking about things like Roth conversions or other strategies that are going to increase your modified adjusted gross income, even if it's strategically part of a strategic plan. Anything that's going to increase our modified adjusted gross income, we have to think, what's that going to do to our qualification for this exemption? It's just an additional thought process that we will have to go through and your tax preparers to help you make wise strategic tax decisions. Next, number 4 here, the higher lifetime gift and estate tax exemption was increased and made permanent. Again, going back to the pre-Tax Cuts and Jobs Act lifetime exemption. And first, we'll start with just a reminder of what the lifetime exemption is. What this means is on a per person basis, your estate, when you pass away, can reach a certain amount of money before it's subject to federal estate tax. And it's the amount that you can gift over your lifetime as well without being hit with that federal gift and estate tax. Back in 2018, this amount was $5,450,000 per person. So that has increased since that time. For 2026, again, this is not a 2025 provision, this is in 2026. That lifetime exemption is $15 million per person. So in a household of two, essentially you can have an estate, assuming you leave everything to your spouse after you pass away, you can have an estate of around $30 million and not pay federal. Most of us means that we don't have to worry about this. And one of the things we always talk about when we're being asked or thinking about, hey, do I need to do something about the amount of tax on my estate? First, we have to answer the question of, is there going to be enough money in there to have to even worry about federal estate tax? And for most people, the answer is no. This ceiling, this lifetime gift and estate tax exemption amount back in the early 2000s was in the $1 million, $2 million range, and as you can see has really increased over the past couple of decades up to 15 million a person. So this increase was made permanent, and every year this amount goes up a little bit over time. So unless something changes, that amount will continue to increase in terms of the amount of assets you can have and be under that exemption limit. We're going to switch the theme a little bit and talk about something that has not changed, and that is your Social Security benefits being taxable. As of the legislation that was signed into law, there is no provision for your Social Security benefits to be tax-free. There was a lot of misconceptions and misstatements and promises that weren't able to be kept for who knows why. But there's a lot of folks who are under the impression that something should be changing with the taxability of their Social Security benefits, and that simply isn't the case right now with how the bill is written. So there are no changes to the rules around the taxation of your Social Security benefits. As of today, and this is no change, the rules pre the legislation being signed, somewhere between 0 and 85% of your Social Security benefits are taxable. Where you fall on that spectrum depends on how much income you have each year. As your income goes up, you get closer to that 85%. And Social Security is historically and will continue to be taxed at your income tax bracket rate. No changes to the taxation of your Social Security benefit, even though that was one of the communicated selling points and benefits of this legislation. This year and going forward, you should expect your Social Security benefits to continue to be reported on your tax return as income tax. That brings us to the end of this video, part 1. We have about 5 more important tax changes that we'll be putting into our next video here. Again, just making these a little bit shorter and more digestible. If you have any questions about how any of these tax changes impact you, or how any other provisions of the bill that you feel are interesting or may impact your tax or financial picture, please reach out to us. We're happy to talk about it, and stay tuned for part 2. Until then, take care.